Okay, cool. All right, so we are back, and we're going to pick up where we left off on slide 7 of deck 4, and we're talking about association again, and some more supporting rules. We're now into subsection 256 1.2, and this is kind of a neat provision in the sense that it takes a lot of what you thought you knew about what control meant and how you identify groups, etc., and all these common law concepts, and it more or less throws it out the window for the purpose of determining if two or more corporations are associated. So first, and directly contradicting what we talked about earlier, paragraph 256 1.2a provides that for the purposes of subsection 256.1, a group is any two or more persons who own shares of a corporation. So this means that in determining association, there's no need to look for a common connection between shareholders. Anytime you see a group or anytime you just see multiple shareholders, just mathematically aggregate them, they're a group, right? So this means that if you have a widely held CCPC, for example, and you and some guy you've never met are shareholders, and you don't even need to be very big shareholders, but are shareholders of this corporation, you're a group for this purpose, right? Notwithstanding that you have no idea who this person is, you don't know that they're a shareholder, never met them, no matter. Second, there is a common law rule that provides that where a member or members of a group control a corporation, it's the smaller group that controls the corporation and not the larger group. So basically, control rests with the smallest number of people to get you to 50% plus one of the voting shares, whether that's a single person or two persons or three persons, etc. And it doesn't matter that there's function in a larger group. So we do see this in some cases. For example, like we see this in cases like Vinrug and Southside Car Market, etc., where you might have, for example, a group of brothers who, I think that was the case in one of those cases, where there's like a group of brothers who control the corporation, and the argument would be that all three of them are the group that controls because they all own 33% of the shares, takes at least two of them, they all act in concert, there's sufficient common connection, they should be a group, etc. But what the courts had said is that, well, no, for the purpose of determining if the corporations are related, etc., or determining who controls, that you just take the smallest groups. You just pick two of the brothers and you say, well, they have 66%, therefore that those two people are the group that controls. The end, smallest possible group. So this is not the rule for association, obviously, since, like we said, it ousts a lot of common law. Paragraph 256 1.2b provides that a corporation is controlled simultaneously by both a larger group and a smaller group, which has the result of throwing out this requirement for the smaller group, and it forces you to consider both factual permutations. So in our brothers example, it requires you to consider the effect of the two brothers controlling and the three brothers controlling, and so you'd actually have to consider three options, at least four, I guess, because you'd have brother AB, brother AC, brother BC, and brothers ABC, all as the controlling group. And so you'd have four different permutations of the facts that you'd have to consider as a result of paragraph 256 1.2b. And then third, this is now completely getting outside of what we would think of normally in tax land. Paragraph 256 1.2c creates a test for control based on value. So under this test, a person controls a corporation if they own shares having a fair market value equal to more than 50% of the value of all of the shares, or if they own common shares having a fair market value equal to more than 50% of the value of all of the common shares. So again, that's completely new, right? Normally in determining if people control, you're looking at votes, and the economic entitlement is totally irrelevant. But here it's now, for association purposes, highly relevant under paragraph 256 1.2c. So then if we flip to slide 8, we get now, in addition to our normal rules, we now have indirect ownership rules and look-through rules to contend with. And these can cause the shareholders of a corporation, the partners of a partnership, or the beneficiaries of a trust as being treated as owning the shares of a corporation, where the shares are owned by a holding corporation, a partnership, or a trust. So first, and the really easy one, is paragraph 256 1.2d, which deems the shareholders of a holding corporation to own the shares of a lower tier corporation in proportion to their fair market value of the shares of the holding corporation. So that's pretty straightforward, right? Like if we have a holding corporation that has a single class of shares and 4 shareholders, and that holding corporation owns 100% of the shares of OpCo, then as a result of paragraph 256 1.2d, all the shareholders of OpCo are deemed to own all the shareholders of Holdco are deemed to own 25% of the shares of OpCo for the purpose of testing if anybody is associated. So again, pretty straightforward. It can get a little bit weird, but you have many different classes of shares, and you need to figure out how value is apportioned in order to determine people's relative value, but usually not that hard, right? Next, subparagraph 256 1.2e deems the partners of a partnership to own shares of a corporation that are owned by the partnership in proportion to the share of the income for the partnership for its current fiscal period. And for this purpose, we're assuming that the partnership has income of $1 million in the current fiscal period. So basically we'd say is, if the partnership had income of $1 million, how would that income be divided under the partnership agreement? And then you say, okay, well, having seen that income allocation, then we apportion the share ownership in that manner. So, obviously some partnerships, especially for example, professional partnership, everybody's entitlement to income can change on a year-to-year basis. And so it could be that, your percentage ownership, deemed ownership of shares for association purposes through a partnership under paragraph 256 1.2e could change from year to year. And as well, obviously that $1 million hypothetical number is just to make sure that if there's a loss or something like that, or if you have like a waterfall effect on the income allocation in your partnership agreement, that it basically creates a hypothetical to test that. So obviously the waterfall effect kicks in at over $1 million, then probably it's going to be disregarded. But if the waterfall kicks in somewhere under that, you do have to care about it at least a little bit. So that's paragraph E. Then paragraph F deals with trusts, and there's actually separate rules here depending on the type of trust that you're dealing with. So the third rule, which is the first part of paragraph F, is clauses 256 1.2 F1A and subparagraph 256 1.2 F2. And these, the reason there's actually like 4 different rules kind of depends on whether you have testamentary trusts or inter vivos trusts. But in any case, there's basically 2 rules. The first is in clause 256 1.2 F1A and subparagraph 256 1.2 F2. And what these do is, if you have a discretionary trust, then every beneficiary of the discretionary trust is deemed to own 100% of the shares of the corporation that are owned by the trust. So, you may be saying, well, that's commercially impossible, right? If my trust has 10 beneficiaries, they can't all own 100% of the shares. That would mean that we have, like 1,000% of the shares. Like, that can't be right. That's an impossibility, but the Act basically says, well, we don't care that that's an impossibility. That's the rule. And so, best way to think about this is as an anti-avoidance rule, right? That we don't want to go through some kind of mechanism of figuring out who owns what in a discretionary trust. We don't want to have to go look through who got what distributions in the past. We don't want to figure out get into the esoteric fight about how you value a discretionary trust interest, which is a thing that family courts like to do. We're just not going to have that fight. Everybody owns 100%. Tough luck, right? Is basically how that rule works. The second rule is in clause 256 1.2 F1B and subparagraph 256 1.2 F3. And what these rules do is they deem each beneficiary of a fixed trust to own shares owned by the trust based on the fair market value of their fixed interest in the trust relative to the fair market value of all other interests. So basically, a fixed trust gets treated like a corporation for the purpose of the look-through rules. So, like I said, the type of trust can make a pretty fundamental difference in how the look-through rules apply. Everybody good there? Okay, seeing none, we can flip to slide 9. And this is where things get messy, is the stuff on slide 9. So first, subparagraph 256 1.3 deems shares owned by minors to be owned by their parents for the purpose of determining if a corporation, if two corporations are associated. So this is a real trap in practice, right? I don't think I've seen anybody fall into it for a while, but it's a real trap, and it will burn people in hilarious fashion. And the reason why it burns people in hilarious fashion is that it operates in conjunction with the deeming rule in subparagraph 256 1.2 F2, which is the one that applies to inter vivos discretionary trusts. So the way this works is that you would first apply subparagraph 256 1.2 F2, and you say, okay, well, every beneficiary of the trust owns 100% of the shares of the corporation that are owned by the trust. And this might include some minors, because people often put minor beneficiaries into their family trusts. And then you say, well, oh crap, subsection 256 1.3 deems the parents to both own 100% of the shares of the corporation owned by the trust. So you can have comically disastrous results with the combined application of those rules. Or let's say we have a family holding corporation that's owned by the family trust. Shares are all owned by the family trust, and the family trust has minor beneficiaries. And we suppose that, let's say, dad is a lawyer and has a professional corporation, and mom is a doctor and has a professional corporation, and there's no cross-share ownership, so those corporations wouldn't be associated with one another. But mom is now deemed to own 100% of the shares of family holding corporation, and dad is deemed to own 100% of the shares of family holding corporation. And so as a result, they're both associated, both PC and dad's PC and mom's PC are now associated with the family holding corporation, because we've satisfied the cross ownership rule and the related person ownership rule, right? As a result of applying the look through and the deemed ownership, and as we're about to see in a couple of slides, the result of both corporations being associated with the family holding corporation, now the professional corporations are associated with one another too. So we've now associated all three corporations. Everybody shares a single business limit, and in fact, since family holding corporation probably generates passive investment income, it's going to grind the business limit anyway, and so probably nobody gets any small business deduction. So instead of getting 2, you got 0, and that happens. I can tell you, I have seen files where we've had to clean up after other people's work, and that happens. So do not let that happen to you. If you are in practice and you have you have clients where usually it's husband and wife, and both are professionals or working or carrying on business through corporations in some form. Family trusts with minor beneficiaries are going to they're going to screw you badly. So don't do that, right? And that's like, there are, maybe if you're not going to practice tax, or you're going to like dabble in tax, which is incredibly dangerous, there's like 3 things in this course you really have to pay attention to, and that's probably one of those 3 things. You will know one of the other ones when you see it, because it's going to be, I will basically, there won't be like exploding GIFs on the screen, but it'll be patently obvious when we get to that other one. Next is subsection 256 1.4. And this subsection 256 1.4 deems rights to acquire shares or rights to cause the corporation to redeem another person's shares to be exercised unless the option is contingent on the death, permanent disability, or bankruptcy of an individual. So this is basically paragraph 251(5)(b), but for association purposes as opposed to relatedness purposes. Again, this is something that burns people routinely. Where people are, for example, outside investors in a corporation with a unanimous shareholders agreement. Corporate lawyers love to jam crap into unanimous shareholders agreements, like all kinds of rights to acquire shares, cause shares to be acquired upon certain events, and normally death, permanent disability, bankruptcy of an individual, those are pretty important things. So you'll have those in there. But what they cannot resist doing is adding in things like a compulsory purchase of shares upon a shareholder getting divorced, for example, which I do question if that makes any sense from matrimonial property standpoints. Matrimonial property orders generally attached to value rather than to specific assets. But in any case, stuff like that, they will jam in there, and not good, right? Those are not good rights. So now, in the purpose of determining, for example, if a person owns shares of that corporation and owns shares of another corporation, those rights are all deemed to be exercised. And if the right is for a compulsory repurchase upon it, or a potential repurchase, doesn't have to be compulsory, it can just be contingent right to repurchase or entitlement to repurchase on the divorce of a shareholder, then you've got to pretend that every other shareholder got divorced, and now the corporation has exercised its right to cause the shares to be repurchased, and so now you're the 100% shareholder of this corporation that you might be a small minority shareholder in, and now you've associated it with your other corporation. So, unanimous shareholder agreements, very helpful, very excellent from a commercial law standpoint. Can be quite problematic from a tax standpoint if you have shareholders with other businesses where you're trying to avoid association. That's one that will catch people by surprise. It's not usually as hilariously disastrous as subsection 256 1.3 when it goes wrong, but it does, that one does, at least in theory, go wrong, usually without being detected though. And then finally on this slide, we have subsection 256 2.1. And this is an anti-avoidance rule that causes 2 or more corporations to be associated with one another if one of the main reasons for the separate existence of the corporations is the reduction of tax. So in other words, if 2 unassociated corporations exist because someone is trying to claim 2 small business deductions, then the corporations are deemed to be associated. So there's been a bunch of case law recently with subsection 256 2.1. Of the 2 most recent cases, taxpayers won one, they lost the other. And some on the older ones, taxpayers, again, it's a mixed bag. Sometimes you win, sometimes you lose. The important point is that it's, again, it's one of the main reasons test. Right, so it doesn't have to be the main reason why you have 2 separate corporations, But if any one of the main reasons, again, ignoring that is just offensive to the English language, if any one of the main reasons for the separate existence of the two corporations is to reduce tax because you're causing them to, to multiply the small business deduction or to, overclaim SR&ED, then the corporations are deemed to be associated. So again, like I said, there's a few examples of this recently. One example was a recent case called GenCal Holdings, which actually involved the people who own Cal Tire, not like the individual dealers, but the actual like Cal Tire brand, etc., and where they had tried to split the business, well, not some split the business, but cause non-associated corporations come into existence so that they could pay management fees and interest, which would be recharacterized as active business income, to multiple shareholders that were multiple corporations that were owned by the children of the founder. And that one went. If you want to see a case that where you're not exactly sure how it went to trial based on the available evidence, that is a good case to look at, where no witness who was remotely credible was able to say that they had any plausible non-tax reason for that plan, other than like that was it. Just some self-serving language and documents that got pointed to as being the reason why it wasn't tax motivated. But nobody could plausibly get on a witness stand and not like just shamelessly perjure themselves. So that's an example. There's another recent case called Prairie Lane Holdings. That one the taxpayer actually won. Interestingly enough, because they accidentally got a small business deduction. They didn't think they were entitled to it. They did a reorg. The tax lawyer who implemented the plan, fell on his sword, appeared as a witness, said he had given incorrect advice to the client. He thought they were not going to get the small business deduction after they did the reorg. But because he didn't understand how the allocation rules for taxable capital through partnerships worked, that they actually accidentally got two for a year before the taxable capital caught up with them. And so the taxpayers won that one, where the court basically said, well, quite credibly, if you were told that this tax benefit didn't exist, you couldn't have done it for tax purposes, right? So that was a good win. And then finally, the other somewhat recent case that you might take a look at with 256 1.2 is a case called Maintenance Eureka. And again, that one is the really classic example of what subsection 256 2.1 is intended to prevent. And in that case, you had a husband and wife who were basically, and it was really husband's business. But what he did was to try to get two small business deductions. He effectively split the business between two corporations, one controlled by himself, one controlled by his wife, and caused different aspects of the business to be carried on by each of the two corporations. So like one corporation did one set of activities and invoiced the clients. The other did a separate set of activities and invoiced the same clients for that separate set of activities, so that both had $500,000 of income and two small business deductions. That one, it did not work. The corporations were associated under 256 2.1, because ultimately, again, it's a factual determination, and dude's wife appeared as a witness and basically admitted that she had no knowledge of the business. She had no idea what her husband actually did for a living. She was told to sign stuff, and so she did. And and in that case, it was really obvious that there was no reason for this arrangement other than the reduction of tax, because any argument that they were doing it so that wife could have an interest in the business or could carry on part of the business at her own direction was obviously make believe when she appeared as a witness and said that she had no idea what the business actually was. So not again, something that probably should not have gone to trial, and may have just been a lack of adequate witness prep. But in any event, that's an example. So are we all okay there? Okay, if we are, then let's flip to slide 10. And this is something that I alluded to earlier. So this is the equivalent of subsection 251.3 for relatedness, but this is for association. It's subsection 256.2. And so if we just flip open our acts, this is important because they actually amended how this rule reads a couple years ago, and it actually makes a pretty significant difference in its operation as a result of as a result of the changes to the wording. So if we just go to that provision, what we see, okay, is that there is an exception in paragraph B, but if we start with paragraph A, which is the important part, the basic rule is that two corporations are deemed to be associated with one another if they were not associated, but for the application of this rule, but both corporations are associated with or are deemed to be associated with the same corporation at the particular time. So that's, that's again, exactly like the way subsection 251.3 works so far. The interesting point there is that, again, it talks about deemed association. So for example, if two corporations are associated solely because of subsection 256.2.1, which is a deemed association provision, well, then, that can matter, right? If they're deemed to be associated with a third corporation versus just ordinarily being associated. And I do believe we have an example of how this could work in real life, again, that we'll get to in a little bit. So don't worry too much if you're having a bit of trouble imagining how corporations could be not associated with one another, but associated with a third corporation. We're going to see that momentarily. So then we get to paragraph B, which is the exception to this rule. And paragraph B, first of all, it has an out where if the corporation is not a CCPC at the particular time, the third corporation is not a CCPC at the particular time, then they're not deemed, the two corporations are not deemed to be associated with one another. They're still associated with the third corporation, but they're not associated with one another. And, again, this exception makes sense. If you think about what the association rules are trying to prevent is basically the multiplication of tax benefits that are, to which CCPCs are entitled. So if the third corporation isn't a CCPC, then, who cares, right, is the answer. So subparagraph B1, again, isn't out if the third corporation is not a CCPC. So that's all well and good. Then subparagraph B2 applies if the third corporation is a CCPC and elects under this section to not be associated. There's a prescribed form of that. It goes from the T2. Then the two corporations are deemed not to be associated with each other at the particular time, and the business limit of the third corporation is deemed to be nil. So again, that makes sense if we think about the effect of the third corporation's business limit being deemed to be nil, then that effectively puts it in the same position as it would be for small business deduction purposes if it wasn't a CCPC. So that's consistent with subparagraph 1. The two corporations are still associated with a third corporation, but not each other. And they're still associated for purposes other than section 125. So that's where there was a bit of a change a couple of years ago to that provision. Previously, it just provided all three corporations were disassociated, or that the corporations were just not associated with the third corporation, which caused them to be disassociated. And that had some interesting effects on taxable capital and on planning to avoid the subsection or the paragraph 125 5.1a taxable capital grind. And so that was amended so that the corporations would remain associated with third corporations, that you couldn't do some of the more interesting taxable capital planning anymore. So that is subsection 256.2. Any questions there? Okay, seeing none, we get to do problems. So that's exciting. So if we go to, we're on handout number 10 and problem 3A, and so this is also slide 11 of the handouts. I'm sorry, of the slide deck. So if we are looking at our facts, we have individuals A and B both own 40% of the voting common shares of ABC Co., which is a CCPC. C owns the remaining 20%. B and D both own 45% of the common shares of BDE Co., and E owns the remaining 10%. A, B, C are brothers. A is married to D, so they're related by marriage. E is not related to A, B, C, or D. So our first exercise is to figure out if the corporations are associated. And so obviously this is the lot. And so we've got to start with our deeming rules, right? As we work our way through this problem, which I know you may have done this at home. So if you have, bully for you, this is the chance to check your answers, right? So we got to start with our deeming rules. And in particular, paragraphs 256, 1.2a and b. So as a result of these deeming rules, ABC is controlled by both the related group AB and the related group ABC. And then BD, BDE is controlled by the related group BD and the unrelated group BDE. So BD is a related group because A, B, and C are related to one another by blood, and they are therefore related. They are therefore related to D by marriage, since D is A's spouse. And so the easiest way to analyze this is to, notwithstanding that we have the simultaneous control by larger and smaller groups under paragraph 256 1.2b, we can get to an answer by just compressing things to the smallest group and going from there. So we can say that group ABC is controlled by AB because those two shareholders have 80% of the votes if we just compress them together. And our ABC is controlled, or corporation BDE is controlled by the BD related group again, because they have 90% of the shares when you compress them together. And those are both related groups. So we now have two related groups. And so we can then drop into, we know at this point that we're dropping into paragraph 256 1E, which is our related group rule. And this requires that one member of a related group be related to all of the members of the other related group. That condition is satisfied because A is related by blood to B and by marriage to D. So we're good on the first condition. And then the second condition requires that one member of both related groups owns 25% or more of the shares. And that condition is satisfied because B owns all of the shares, B owns 40% of the shares of ABC and 45% of the shares of BDE. And B is also related to every member of both related groups. So there we go, right? We know that they're associated as a result of compressing into those groups and then applying paragraph 256 1E. So that's fine. And then the problem then moves on to ask, well, are they related? And here the answer gets much easier, right? Because now we have the common law rule that we look for the smallest group that controls ABC and the smallest group that controls BDE. And so we aggregate, we compress down into the smallest group, and then we compare, right? So again, we have AB and BD as our two related groups that control, which are conveniently also the smallest possible groups that could control, although there's other variations, but those are easy related groups that are as small as possible and that control. And again, A and B are related to everybody in ABC, and they're related to everybody in BD. And so as a result, the corporations should be related to one another. We should have the result that AB are related to ABC, BD are related to BDE under subparagraph 251 2B2. And then since our related group ABC is related to B, who is a member of related group BD, then as a result, the corporations are related to one another under subparagraph 251 2B3. So we in fact did not even need paragraph C at all in that problem to cause the two corporations to be related. We just got there by having related groups. And by being, as a result of the corporations being related to their related groups, they were therefore related to other members of the other related groups and therefore related to the corporation. So that's problem 3A. And then if we, which I think they get a little bit easier than that in some instances. So we can flip to problem 3B, and this is slide 12, and problem 3B handout 10. So in this problem, Mr. A and his brother spouse, Ms. B, both own 50% of the issued voting shares of AB Co. These are the only outstanding shares of AB Co. which carry on an active business in Canada. Mr. A also owns all of the outstanding shares of A Co, while Ms. B also owns all of the outstanding shares of B Co. A Co and B Co carry on active business in Canada in a partnership. The two corporations share in all income and loss on a 50-50 basis. A Co, AB Co, A Co, and B Co are all incorporated in Canada in 1985. None of the issued shares are traded on a stock exchange. Mr. A is a Canadian resident. Miss B is a US resident. So we can now start to work our way through that. That's a lot of facts, but at least it's many fewer people than the last problem, so it's less to keep track of, at least. So what we do know to start is that A and B are related by marriage within the meaning in subsection 251.5 and under paragraph 251.2a, because A and A's brother are related, and B, being the spouse of A's brother, causes them to be related by marriage. So we know they're related. So obviously, in that case, the related group that controls AB Co, the two corporations they control are related under subparagraph 251 2C2. Their corporations are also related to them individually under paragraph 251 2B1. And so, everybody's related here, right? That's easy enough to identify. But then we can start to identify what might or may not be relevant in determining if the corporations are associated. So easy one is that the partnership and its income allocation are irrelevant. it might be relevant, if we were trying to determine if there's specified partnership income, but for the purpose of association, because the partnership doesn't own shares of a corporation, the partnership, or at least we didn't specify that it does, the partnership is entirely irrelevant. And as we're about to see, it's also irrelevant that Miss B is a U.S. resident. That doesn't matter. There could be permutations of this problem where it would matter, but it doesn't matter here. So then our next step is to determine who is associated with AB Co. Right? So our relevant rule here is paragraph 256(1)(d). Since A Co and B Co are both controlled by a person, and AB Co is controlled by a related group. So A Co will be associated with AB Co if A is related to himself and to B, which he is, because subsection 256(1.5) deems you to be related to yourself for these purposes. And if A owns at least 25% of the shares of AB Co, which he does. So we have our relatedness, we have our cross ownership, and so everybody is, so A Co and AB Co are associated under paragraph 256(1)(d). And so the same reasoning also applies to B and B Co and AB Co. So for the exact same reasons, B Co and AB Co should also be associated. So then we have to look at A Co and B Co as separate corporations and figure out if they're associated with one another. So they are not. The potentially applicable rule to start with is paragraph 256(1)(c), since both corporations are controlled by an individual and the individuals are related to one another. However, that rule can't apply because there's no cross ownership of shares in either corporation. A doesn't own shares of B Co, B doesn't own shares of A Co. However, they are potentially associated under subsection 256(2), since both A Co and B Co are associated with AB Co. So we do have the potential for an election, in this case under paragraph 256(2)(b), where they could elect not to be associated, or more correctly, where AB Co could elect and cause A Co and B Co to not be associated with one another. But again, that only applies for the purposes of section 125. So for all other purposes, they are associated, right? And importantly, you also cannot rely on the preamble. You cannot rely on subparagraph 256(2)(b)(1), which is the rule that provides that a non-CCPC is not a third corporation that can cause two corporations to be associated for the purpose of section 125, because AB Co is a CCPC. So here, the fact that Miss A is a U.S. resident is relevant, but Miss A only owns 50% of the shares, which is not enough to control. And so, in this case, we have, it's not that it's controlled by Canadians, but there's the absence of control by a non-resident, which is all that we need for the corporation to be a CCPC. So AB Co is a CCPC, and so that exception doesn't apply in any event. So that's not great. Right, so everybody is associated, is where we get to at the end of this problem. Yeah, can we go over the A Co and B Co association again? Absolutely, we can do that. So A Co and B Co, they're not associated under normal rules, right? Like the normal rule here is that both are controlled by one person, right? A controls A Co, B controls B Co. So your normal association rule is paragraph 256(1)(c), and that can't apply because it requires cross ownership, and there's no cross ownership between ACO and BCO. So they can't be associated normally. So we know that if they're going to be associated, it's because they're deemed to be associated with one another. And in this case, the deemed association rule that we care about is subsection 256(2). And subsection 256(2) applies to cause ACO and BCO to be associated with one another because both corporations are associated with a BCO. And so because they're both associated with a BCO, which we did go through that one, then they're deemed to be associated with one another under subsection 256(2). And what we talked about is that there are two exceptions that apply for the purposes of the small business deduction to potentially cause an out from subsection 256(2) deemed association. The first is applicable automatically where a BCO is not a CCPC, but a BCO is a CCPC because B doesn't control. So that doesn't apply. And so that kind of gets us to the fix, right? Is the potential fix here is that if we're worried about the small business deduction for ACO, BCO is not a CCPC. So BCO can't claim a small business deduction. So BCO doesn't care, ultimately, whether they're associated or not. But A and ACO care deeply about whether they're associated. And so the potential fix here is to elect under subparagraph 256(2)(b)(2) for ACO and BCO to not be associated with one another, which again, that only applies for the purposes of section 125, but that's really all we care about here because that gets that entitles ACO to the small business deduction in respect of its 25% or sorry 50% rather interest in the partnership. A BCO, if it makes that election to cause ACO and BCO to be disassociated, its small business deduction entitlement, its business limit is deemed to be nil. But in our fact pattern, it looks like a BCO doesn't actually carry on any business, so we probably don't care, right? And so you probably would make that election in real life so that you can at least potentially preserve ACO's small business deduction if association might cause it to get ground. No problem. Okay, so that is that for that problem. And then we can go to very quickly, we can do problem 6.1, which I've reproduced on slide 13. And so the question here is, are these two corporations associated? So we take a look, we have Mr. A owns 100% of ACO, ACO owns 25% of BCO, A's sister owns 75% of BCO. So are they associated? I can throw that out to the group. I don't really need you to tell me why, but are they associated? The answer is yes. Yes, they are associated. So here, the important starting point is that A and sister B are their. I mean, I guess we could call her Ms. B, but I guess we're calling her sister B to make sure it's clear that they're related. Although I suppose sister B could be a nun, in which case then that would not work. But let's assume they're Protestants or something. So A and B are related under paragraph 251(2)(a) and subsection 251(5) by blood because they're siblings. So our relevant rule, because both corporations are controlled by a single individual, is paragraph 256(1)(c), right? It is our relevant rule. And so, basically that rule, as we've gone over, requires that both corporations be controlled by a single person. That single person has to be related to the person who controls the other corporation, and one of the two people has to own, in respect of the other corporation, at least 25% of the shares of a particular class. So, so far we're saying, well, look, it doesn't look like there's any cross ownership, right? But then we go to our supporting rules, and we go into paragraph 256.1.2d. And paragraph 256.1.2d deems A to own the shares that are owned by ACO. So now A owns 100% of the shares of ACO, 25% of the shares of BCO, is related to sister B by blood. Sister B controls BCO. So now we have in fact satisfied all of the conditions of paragraph 256.1c after applying our look-through rule. So yeah, the result is the corporations are associated. Obviously, they're also related as well, right? They could be related under subparagraph 251.2c2, or we could also get there just relying on subparagraphs 251.2b1 and 3. We can also get there them being related. So they're associated, which is what we really care about, but they're also related. Okay, everybody cool with that? All right, taking silence as a yes. Let's take a break. Let's try to take 10 or 9, whatever. We'll come back somewhere around 3 o'clock and we'll pick up. So I'm going to stop recording and then we can do that.